One of the great mysteries of accounting are the terms debit and credit. Accountants use these top-secret terms to speak a special language that only those in the accounting club can decipher. So what do those terms mean? Well, debits and credits are terms used by accountants a lot, and they do have special meaning, but they certainly aren't top secret, and they certainly aren't difficult to unravel and understand. Nowadays, debit simply means left, and credit means right. No secret, but the hard part is perhaps the next step. Left and right of what? Well, in other tips, we've talked about the balance sheet and the income statement, and you'll remember assets, liabilities, revenues, expenses, and the like. Each of these is broken down further into specific accounts like cash, inventory, supplies, land, taxes payable, etc. And each of these accounts can do one of two things. They can go up and they can go down. Cash goes up or it goes down. Taxes payable goes up or it goes down. Think back now to the accounting equation. Assets equal liabilities plus owner's equity. It has to, by definition. So asset accounts go up and down, liability accounts go up and down, and owner's equity accounts go up and down. When double entry accounting was formalized, all the adding and subtracting, accounting for those ups and downs, was done by hand. You can imagine the difficulties of tracking multiple accounts involving hundreds of transactions when doing all the computations by hand. Mixing pluses and minuses in one column would provide ample opportunity to make mistakes. This problem was solved by separating the pluses and the minus for each account into separate columns, totaling each column, and then computing the difference between the columns to arrive at an ending balance. In other words, keep track of all the ups, keep track of all the downs, and then just take the difference between all the ups and downs, the increases and the decreases. So each account was split into two sides. The simplest, most fundamental format is the configuration of the letter T. This is called a T account. For example, here is a cash T account with the increases tracked on one side and the decreases on the other. Transaction amounts may be recorded on both the left side and the right side of the T account. Instead of using the terms left and right to indicate which side of a T account is affected, terms unique to accounting were developed. Debit, abbreviated DR, is used to indicate the left side of a T account, and credit, abbreviated CR, is used to indicate the right side of a T account. Debit means left, credit means right. Nothing more, nothing less. In addition to representing the left and right sides of an account, the terms debit and credit take on additional meaning when coupled with a specific account. By convention, for asset accounts, debits refer to increases and credits refer to decreases. For example, to increase the cash account, we debit it. To decrease the cash account, we credit it. Since we expect the total increases in the cash account to be greater than the decreases, the cash account will usually have a debit balance after accounting for all transactions. Thus, we can make this generalization. Asset accounts will usually have debit balances. The effect of this system is shown here, with an increase indicated by a plus and a decrease by a minus. Now, here's the hard part. Here's the mystery. And here is also the genius of this system of debits and credits codified over 500 years ago. In addition to assets equal liabilities and owner's equity, debits should always equal credits. If you fully grasp the meaning of these two equalities, you are well on your way to mastering the mechanics of accounting or learning the language of accounting. Debits and credits allow us to take a shortcut to ensure that the accounting equation balances. If, for every transaction, debits equal credits, then the accounting equation will balance. Every time an account is debited, other accounts have to be credited for the same amount. This is the major characteristic of the double entry accounting system. The debits must always equal the credits. For example, when we buy inventory paying cash, our cash account goes down and our inventory account goes up. Since cash is an asset and assets go down with credits, we know cash is credited. Inventory is also an asset and it went up. Assets go up with debits. So inventory is debited and cash is credited for the same amount. Debits equal credits, and the accounting equation still balances. This important characteristic creates a practical advantage, the opportunity for self-checking. If debits do not equal credits, an error has been made in analyzing and recording the entity's activities. There you have it. Debit means left, credit means right. But the real insight is that a debit to an asset account means increase, and a credit to a liability or owner's equity account also means increase, and the reverse is true. A credit to an asset account means decrease, and a credit to a liability or owner's equity account means decrease as well. If all the debits equal all the credits, then we know that the accounting equation will be in balance. It's a beautiful self-checking system.